You know, right now, there's an invisible war being fought. It's a war with no soldiers, no actual battlefields, but it has the power to bring our entire global economy grinding to a halt. $14.5 trillion. Yeah, you heard that right. That's a number from a Lloyd's of London scenario. It's what we could lose economically over 5 years if a major geopolitical conflict totally cripples our global supply chains. I mean, it's an absolutely staggering figure, and it just goes to show how fragile this whole system really is. So, a number that big, it brings up a really crucial question, right? When disaster strikes, say a ship gets attacked or a port is hacked, who ends up footing the bill for all those billions in lost goods? You might think it's simple, but trust me, the answer is way more complicated than you'd think. Okay, to really get what's at stake here, you have to wrap your head around the sheer scale of it all. We're talking about over 80% of all world trade traveling by sea. Think about it. At any given moment, something like 11 billion tons of goods are out there, on the water. The phone you're holding, the food you ate for lunch, pretty much everything depends on this massive, silent, and, as we're finding out, deeply vulnerable system. So how in the world do we protect a system this huge? Well, the idea of sharing risk when you're out at sea isn't new. In fact, it's ancient. It's all built on a maritime code that goes back centuries. It all comes down to this really fascinating old school concept called general average. Picture this. Your ship's caught in a massive storm. To save the vessel, the captain has to start throwing cargo overboard. Now, under general average, it's not just the owner of that specific cargo who takes the hit. Nope. Everyone with goods on that ship has to chip in and share the cost of the loss proportionally. It's a pretty powerful idea, right? The core message is, we are all in this boat together, literally. Of course, today, we're not exactly passing a hat around the deck to collect money. The modern solution, as you can probably guess, is insurance. You've got the ship owners buying policies, the cargo owners buying policies, and together they create this really sophisticated web of protection that basically solves that same age-old problem. And this isn't just some free-for-all. Marine insurance is built on some really solid, centuries-old principles. You've got these core ideas like utmost good faith, which basically means everyone has to be completely honest. Then there's proximate cause, which helps figure out the exact one thing that led to a loss. These are the fundamental rules of the game, the bedrock of the whole system. But, and you knew there was a but coming, right? While those rules seem pretty straightforward, there's a little complication, a hidden clause, buried in the fine print, and it changes everything. See, your standard policy, it's designed to cover the random, unpredictable violence of nature. A huge storm, a collision. But what happens when the threat isn't random? What if it's deliberate, totally man-made, and part of a bigger conflict? And here's where the line is drawn. It's a pretty stark divide. Your standard marine policy will explicitly exclude acts of war. For that kind of thing, you need a completely separate policy, something called war risk insurance. And that covers all the stuff the standard policy won't touch. We're talking military conflicts, terrorism, piracy, even a government just deciding to seize a ship. So why the split? Why two different policies? Well, it's because war is just a completely different beast. The risks are so unpredictable and the potential losses are so, well, catastrophic that standard insurers just can't put a price on it. It would be like trying to sell fire insurance in a neighborhood that's already on fire. It just completely breaks their financial models. Okay, but here in the 21st century, the whole nature of conflict, it's changed. The threat isn't a pirate ship on the horizon anymore. Now, it's more like a ghost in the machine. Just think about it. A cyber attack can completely cripple a port's logistics. It can spoof a ship's navigation system, sending it way off course. It can shut down critical infrastructure from thousands of miles away. The battlefield has gone digital, and for the insurance world, this is creating one massive headache. And experts are really struggling with this. Ian Newman from Gallagher Re put it perfectly. He said that the historically well-defined line between an act of war and some other kind of covered problem, it's gotten super blurry with cyber attacks. I mean, for centuries, war was pretty easy to define, right? You had uniforms, you had battle lines, but a cyber attack, whoosh, that line just dissolves. The fundamental problem here is something called attribution, basically figuring out who did it. Cyber attacks are designed to be anonymous. The attackers hide behind layers of proxy servers and spread all sorts of misinformation. And this creates a totally impossible situation for insurers. How can you possibly invoke a war exclusion clause if you can't even prove who fired the first digital shot? So, was that attack on a port's computer system just a criminal ransomware gang looking for a payday? Was it a terrorist group trying to cause chaos? Or was it a nation-state, a hostile government, acting in disguise? The answer to that question determines whether we're talking about billions of dollars in covered losses or nothing. This level of uncertainty, it's just not sustainable. So the entire industry is now trying to fight back. They're trying to draw a clear line in the digital sand. Here's how the industry is starting to visualize the problem. Imagine a spectrum. On one end, you've got simple cybercrime, right? On the far other end, you have a clear, undeniable act of war. But in the middle, that's where you find this huge gray band of attribution uncertainty. And the whole goal now is to draw a clear attribution line, somewhere in that gray band, a point where an attack officially crosses over and becomes an uninsurable act of war. So, how does an attack actually cross that line? Well, the process has to be super rigorous. It starts with an attack that happens in that murky gray area. Then, and this is the really hard part, the responsible party has to be clearly identified. After that, the act has to be officially recognized as part of an actual state of war, not just some random one-off hostile action. Only when all those boxes are ticked does the event finally cross the line and become an uninsurable act of war. But look, this isn't a problem that just one company can solve on its own. Experts like Devin Page are arguing that the entire global insurance and reinsurance communities have to work together on this. They need to proactively create new rules, new fit-for-purpose exclusions for this new kind of warfare. The goal is to create certainty for everyone involved about what is and what isn't covered. So, why should you care about any of this? Well, here's the bottom line. Without that clarity, the insurance that underpins all of global trade could just evaporate. If insurers can't confidently figure out the risk, they're just going to stop offering the coverage. And that could bring the entire, $14.5 trillion system of global commerce to a screeching halt. What this all means is that the digital infrastructure, the servers, the lines of code, the networks that power our world, they've become the new front line. They are, for all intents and purposes, legitimate military targets. The battle isn't being fought in a trench anymore. It's being fought in a server farm. And that leaves us with one last really critical question. The whole system of sharing risk, the one we've been talking about, it was designed for a physical world, a world of storms and pirates. But now, in an age of invisible, impossible to attribute cyber warfare, can that ancient system really keep our modern interconnected world afloat?